Welcome to this short Fin Bites video. My name's Joanne Ross and I am the Senior Module Leader in the Fin module. In this video we're going to look at two topics which can often pop up in practice and in the Fin module exams in a variety of contexts. We're presenting this video in two parts so you can choose which part is most relevant to you. Part 1 is looking at IAS 10 events after reporting period, and Part 2 looks at the interactions of the standards as well as the details of IAS 8. It is good to get the rules in each standard clear in your mind to ensure you are maximising your marks and applying the standards correctly. Let's start with IAS 10 events after reporting period. When is this standard relevant? Well, if we look at our timeline here, we have 3 events occurring during the entity's reporting cycle. IAS 10 explains what to do with events A and B. It is also important to remember that the audit requirements around subsequent events differ a little to the financial reporting requirements, even though there is a lot of overlap. So let's imagine event A is a parcel of land on the entity's balance sheet for $10 million. The entity decides in July 2008 to sell the land. During the course of preparing for the sale in July, they find out the ground has been polluted over many years of industrial use with heavy metals, and that the value of the land will be more like $6 million. The hardest question to answer under IAS 10 is, does this provide evidence of a condition that existed at balance date? In the case of the land, yes, it did. The pollution had already occurred at year end. The information that came up in July told us more about that existing condition. This means it is an adjusting event and we need to recognise the impairment loss on the land in the 30th of June 2008 financial statements. Now let's look at event B. Event B is the same entity. Event B is a building on the balance sheet for $18 million, and our poor old entity is having a bad run and the building burns down on the 31st of July. The entity will receive $15 million in insurance payouts, but they've also lost that building that they had on their balance sheet. This one's quite different to event A with the land. The problem with the building did not exist at year end, and nor did the insurance monies receivable. So this one is actually a non-adjusting event. Both amounts are material, however, so they would be disclosed by way of note. The note would outline the nature of what occurred and the estimated financial effect. The standards gives us some guidance of common adjusting events. So there's a few listed here, and we'll go through a couple of them. A settlement of court case where there was an obligation at year end, a customer going bankrupt, a sale of inventory after year end that may give evidence of a net realisable value issue at year end, or a bonus determined after year end where the obligation existed at year end. We can also see a number of non-adjusting events that the standard provides us with by way of example. Some of the interesting ones are business combinations or discontinued operations after year end, and like event B, destruction of production plant after year end. Things like share issues after year end, changes in foreign exchange rates, changes in tax law pronounced after year end, or the commencement of major litigation regarding events that occurred totally after year end are all some of the examples given to us in the standard. So, once the financial statements are authorised for issue, we've met IAS 10's requirements until the next reporting period. The when and how of authorised for issue can vary a bit between entities, so have a read of paragraphs 4 to 7 for more information. That's the end of part 1 of this video. Go to part 2 for an explanation of the interactions between IAS 10 and IAS 8 and for more detail on IAS 8.